Welcome back to our lecture series on the new principles of economics. Today, we explore the concepts of money and finance. In chapter 11, we discussed the evolutionary perspective on markets, which transcends the traditional distinction between individual and aggregate phenomena, or microeconomics and macroeconomics. In this chapter, we will delve into what is conventionally known as macroeconomics.
This chapter does not include the usual concepts, such as aggregate demand and supply curves. After the great financial crisis of 2008, many leading macroeconomists agreed that the field of macroeconomics requires significant theoretical innovation. In this chapter, we build upon the insights from earlier chapters of our new principles and present a new framework. This framework also integrates the theory of finance with macroeconomics. One of the key criticisms following the 2008 crisis was that the lack of such integration hindered our understanding of the role of finance in the economy. Many leading macroeconomic models at that time did not even incorporate finance.
Our approach to finance is based on the new theory of money discussed in chapter 10. Finance involves economic activities that take place in various markets, each with its own institutional characteristics. It provides a diverse array of services that assist economic actors in managing their budget constraints over different time periods. For example, it allows individuals and businesses to borrow money to meet their immediate needs.
This leads to uncertainty, correct?
Finance can be understood as a set of ways to manage the uncertainty of future monetary flows. For instance, when I borrow money, I might encounter challenges in repaying it later, and my creditor is aware of this possibility.
Another key aspect of finance is that it involves the creation of new types of economic objects, such as bills of exchange and various kinds of bonds. This process is referred to as assetification. The significant power of finance lies in its ability to transform any economic object into an asset. An asset is defined as a claim on the future income that it generates in monetary terms.
Assets are a type of institutional object, and financial markets focus on trading these objects. For example, a chicken can become an asset when a farmer sells its egg on the market, generating monetary flows over time. Suppose the farmer wants to buy more chicken, and someone lends him money with a condition that a portion of the profits from egg sales goes to the lender. In this case, the chicken is assetified, possibly represented by a written agreement that outlines the creditor's claims. If the creditor needs to borrow money again, this document can be used as collateral, creating a derivative claim on the second lender's investment.
As money began to take form, processes of assetification became increasingly universal in market economies, remaining central to modern capitalism.
Our agenda today is ambitious. We will begin by interpreting the emergence of money as a financial phenomenon. Money is essentially assetified debt. This means that when someone lends an item to another person and formalizes that agreement with a document, this contract becomes assetified debt. If the lender can use this claim to repay a loan from someone else, then this claim effectively becomes money, or more precisely, private money.
Private money refers to various types of asset-based debts that are publicly accepted for settling other debts. The other type of money is sovereign money. Traditionally, sovereign entities have used their authority to create money as a resource to cover government expenditures. To anchor the concept of sovereign money within society, rulers mandated that their subjects pay taxes using this officially recognized currency. As a result, sovereign money became a fundamental institution for establishing public units of account. In modern economies, both private and sovereign money together define the monetary system, which is monitored and regulated by central banks.
We then shift our focus to an analysis of the capital market and present the deconstruction of its functions. Traditionally, the capital market is understood as the meeting point between savings and investments, characterized by the supply and demand for funds. In our analysis, we examine two distinct markets where different institutional objects are traded: savings instruments and investment instruments. These instruments are produced by financial market actors such as banks, which operate in both markets.
We do not view participants in these markets as generic, rational financial agents. Instead, we introduce a basic taxonomy of financial actors, such as entrepreneurs and consumers.
Finally, we analyze a key institutional feature of financial markets, the arrangements of liability. Limited liability represents a significant innovation within capitalism and is essential for maintaining the dynamics of finance, particularly in the production of new institutional objects. However, this system also introduces significant risks, as evidenced by the financial crisis of 2008.
Let's revisit the concept of money. In Chapter 10, we noted that a commonly accepted explanation for the existence of money is that it serves as a technical solution for coordinating trilateral exchanges when bilateral wants and needs do not align. Against this, we propose an alternative framework centered around trilateral debt. The traditional narrative of money serving to overcome the non-coincidence of wants and needs and reducing the transaction cost of barter is historically inaccurate. In all known societies, the solution to the problem of non-coinciding wants and needs has been the acceptance of mutual debt. For example, suppose that farmer A needs food because his harvest was bad. B provides him with food, expecting that he will return the favor at a later time.
But couldn't this constellation still entail a lack of alignment in wants and needs? In our example, for B, holding a claim against the farmer may in fact not be a preferred outcome of this transaction.
That is where the trilateral balancing of bilateral debts comes into play. This would require debts to be abstracted from the original goods transaction, resembling promises that are then traded trilaterally. We assumed that A is indebted to B. Let's continue by assuming that A had lent tools to neighbor C for a longer time span, so that C is indebted to A. In turn, C regularly lends labor services to B. These material forms of debt are incommensurable in the sense that the needs do not coincide. However, we can ask whether the promises of paying back the mutual debt can make the relationship commensurable. That would require that the relationship is abstracted from the underlying material base as a generalized IOU. Could we imagine that these promises themselves could be exchanged?
Yes, we can. This leads to the idea of the assetification of debt. In principle, that would turn the promises into a tradable form, such as a letter. Then, for example, farmer A may pay back his food loan from B by handing over his claim on the tool borrowed to C, and so forth.
But the problem of coincidence of needs is simply reproduced.
That depends on the degree of abstraction. If there is a general unit of accounting for debt in an abstract form, people can trade the debt as assets. Historically, as markets matured, the standard form of assetified debt has been a type of IOU, typically represented on paper.
Assuming that there is such a unit of accounting for mutual debt, it looks like those papers were a means of exchange, hence money. Wouldn't bills of exchange be such an example, where the underlying economic transaction is material, such as buying supplies for my business and issuing an IOU to the supplier?
Yes, this is what we call private money. Money is essentially a form of debt that is universally accepted for settling other debts. This concept differs significantly from the traditional view of money as a mere medium of goods exchange in the market.
However, it is still unclear where the public acceptance as a unit of account comes from. We explored the functions of money in Chapter 10. Unit of account was one of them, and another medium of exchange. It seems that the functions are now separated.
Absolutely. This is where the concept of sovereign money comes into play. When we theorize about the original and roles of money, it's important to understand that no single currency fulfilled all monetary functions from the beginning. In reality, various forms of money have always coexisted until modern nation-states unified their monetary systems. Early states used money as a public unit of account to measure tax obligations and sovereign wealth.
And how did that merge with private money?
Over time, sovereigns increasingly relied on the market to procure goods and manpower, including the hiring of mercenaries. These mercenaries would then spend their salaries in the marketplace. In essence, sovereign money and private money began to merge in practice, even though they often retained different physical forms. This concept echoes what we have learned in the first chapter about the coexistence of copper and silver coins in imperial China.
I see. In Chapter 1, we discussed one key difference between ancient China and the emerging capitalist nations in the West. Only the latter unified their monetary systems and developed modern finance. So as a result, today we only have sovereign money?
Not quite. Modern central banks operate with a fractional reserve system. In this system, private banks can create money based on assetified debt, which stems from the deposits that individuals hold with these banks. The newly created money is then used for payments to other parties, creating deposits on different bank accounts, allowing for further money creation. As a result, these financial systems are hybrids of private and sovereign money. In these hybrids, private banks can create money if they do not need to hold 100% reserve of sovereign money. That means once they receive a deposit, they can lend a substantial part of it to others, who in turn spend the money, and the receivers put it on their bank accounts as a deposit. The other bank can lend a part of the money to others, and so forth. In other words, the banking system can create money via the expansion of credit.
This fact highlights why finance cannot be viewed as neutral in modern markets. As we will examine in Chapter 13, finance is a major driver of economic cycles and often a cause of crisis. To understand this dynamic, the roles of trust and expectations are essential. Trust issues are already central in the early stages of monetary evolution. We refer to these as primary monetary communities, where debt exists among market participants, such as a shop owner allowing a trusted customer to delay payment. People lend and borrow various items such as tools, and may also borrow money to purchase a tool. In many developing countries, primary communities continue to dominate financial activities, including lending among family members. Finance is an area where actors specialize in trading asset-backed debt, which we call secondary monetary communities.
Trust issues in the secondary monetary community are quite complex. The main concern is how to accurately assess the creditworthiness of an actor, particularly when it comes to entrepreneurs introducing innovations in an uncertain future. Consider a firm that takes out a loan from a bank. The bank can evaluate the firm's current financial health. However, the firm is connected to many other actors within a complex network. The financial situations of these connections can impact on the firm, even if it appears financially healthy on its own. If many of the firm's customers encounter financial difficulties, it may ultimately struggle to repay the loan, despite having no fault in the matter. In this context, actors in the secondary monetary community specialize in assessing the creditworthiness of others, including their financial partners.
This scenario sets the stage for credit cycles, which are essentially fluctuations in the confidence of market participants, particularly within the secondary monetary community. When these actors are optimistic, they readily extend loans, sometimes to an excessive degree. However, when the market corrects these trends, financial actors become pessimistic, often undermining promising entrepreneurial projects, which leads to further contraction of the economy. In this process, leverage plays a critical role. Leverage implies a rise in shares of external finance in financial assets, which can increase profitability, but also increases the risk of total wipeout in a downturn. We will look into the implications of credit cycles more closely in Chapter 13.
Traditionally, financial sector organizations such as banks are viewed as intermediaries between savings and investment. There are two main approaches to understanding this relationship. The first is the neoclassical paradigm, which posits that savings and investment are determined by the supply and demand for funds in the capital market, with the interest rate serving as the price that balances them. The second is the Keynesian perspective, which argues that savers and investors operate based on different motivations and that there is no direct mechanism to coordinate their behaviors.
Saving refers to the act of postponing current consumption in favor of consuming at a later time. The original form of saving involved keeping physical goods for future use, such as preserving food after the harvest. In a market economy, saving is facilitated through money. This can include hoarding cash or depositing funds in a bank. However, saving comes with inherent uncertainties regarding the future. These uncertainties can include natural disasters that may destroy stored goods or personal circumstances that affect one's survival. As a result, future consumption is typically discounted at a positive rate, which serves as a disincentive to save. In many societies, thrift is perceived as a virtue that should be taught to individuals. Additionally, the concept of money introduces more uncertainty, particularly in the form of potential future inflation. The higher the rate of inflation, the less incentive there is to save.
Investment involves delaying current consumption with the expectation of generating positive future returns. While savings help maintain a stable intertemporal budget constraint, investment seeks to expand that constraint. The anticipation of positive returns serves as an incentive for investment, although these returns are often uncertain. Moreover, investment is generally less impacted by inflation, as future returns are calculated based on future prices.
In a monetary economy, finance allows individuals and businesses to adjust their intertemporal budget constraints for both savings and investment. One significant consequence of this is the possibility of negative savings, which means that people can bring forward their consumption by taking out loans. Since they are not investing in future productive capacity, this situation can lead to a need for reduced consumption later or a reliance on increased income from other sources. Investment directly influences future financial conditions, so changes in factors like the credit cycle can introduce uncertainty.
People have a wide range of perspective on financial activities, which often reflect their roles as economic participants. This diversity can lead to different strategies on financial markets. For example, some individuals may save for retirement, while others choose to invest and become entrepreneurs to reach the same objective. Therefore, it is essential to consider the variety of actors and their motivations. Finance functions within an ecosystem of economic participants.
Is this ecology fixed?
No. For analytical purposes, we distinguish between 6 ideal types of actors, but in reality, these roles are performative. For example, a person preparing for old age may initially choose to save money in a savings account, but then later decide to invest instead. This decision depends on her personal circumstances as well as the broader economic conditions. In our framework, there is a duality involving 2 types of actors that highlights this performative ambiguity: the financial saver and the financial entrepreneur. These roles represent individuals who make decisions based on financial discipline and consider the monetary costs and benefits over time. Essentially, these are the rational agents as understood in neoclassical economics, who respond to changes in interest rates and anticipated returns from investments.
A financial entrepreneur differs from a Schumpeterian entrepreneur by strictly adhering to financial discipline while pursuing an entrepreneurial mission, such as product innovation. Most corporations fit this mold, as they rely on financial markets for external funding, which reinforces this discipline. In contrast, Schumpeterian entrepreneurs view financial discipline as an inevitable burden in their pursuit of their dreams and visions. They focus on real projects, often driven by an utopian zeal. This approach is distinct from that of financial investors, who are primarily concerned with the monetary aspects of investment, specifically the anticipated rate of return, and evaluate alternative investments solely based on this criterion.
Similarly, the entrepreneurial consumer seeks out unique consumption experiences and, engaging in negative saving, is often willing to take this significant financial risk or even overlook them altogether. In contrast, the real saver is frugal and risk-averse. The dominance of either type in the economy depends on the broader social context. For example, after the Great Depression, a culture of thriftiness emerged in the United States, which starkly contrasted with the consumer frenzy that characterized the period leading up to the financial crisis of 2008. when the national savings rates in the United States approached zero.
The traditional view of saving is that it involves depositing money in a bank. However, we propose a different perspective. Banks actually create deposits as institutional objects tied to the services that they provide. Savers pay for these services, leading us to conclude that the natural rate of interest for saving should be negative. This is particularly true for certain savers who are not influenced by interest rates, as their primary focus is on the goal of saving itself. For instance, individuals might save to prepare for health-related risks regardless of interest rates. In countries with financial repression, such as China for several decades, people continue to save, even in the face of very low or often negative real interest rates.
In a system of financial repression, competition among banks is absent. When there is competition, banks can generate profits by lending out deposits to investors. These profits allow them to offer higher interest rates to savers, which in turn helps them attract more deposits. Consequently, the savings interest rate is likely to increase into the positive range. However, the difference between the interest rate on savings and on loans represents the opportunity cost of saving, akin to negative interest.
The market for investment instruments is complex because it involves three types of participants: financial entities such as banks, entrepreneurs, and investors. Investment instruments include various financial products such as bonds, loans, and equity. Financial entities offer these services and instruments to clients either directly or indirectly. Investors can choose to invest in financial entities or directly in entrepreneurial projects. This direct investment often occurs in the primary market, where investors may become partners with limited liability. However, financial entities frequently create financial products and act as intermediaries between investors and entrepreneurs, for example, in an initial public offering, IPO. Additionally, loans in various forms connect financial entities directly with entrepreneurs.
In the modern economy, the markets for savings and investment instruments are interconnected through arbitrage mechanisms, which renders the distribution of different types of investments an endogenous process. For instance, consider the stock market manias in China over the past few decades. In response to financial repression, many households shifted their savings from deposits to stocks, effectively transitioning from savers to investors. However, this shift did not necessarily diminish their primary motivation to save. As a result, stock market crashes can significantly impact their livelihoods.
There is another case in point regarding the connection. In recent decades, Japan has managed to endure a fragile financial sector burdened by a significant amount of bad loans. This stability can be attributed to the Japanese people's tendency to prioritize their savings, which has helped to stabilize the financial sector by maintaining their deposits. In sum, the evolving ecology of economic actors is a major determinant of macroeconomic trends in the economy.
Earlier, we discussed how the financial sector can create private money endogenously. One might wonder why banks compete for deposits if they can simply extend loans as they wish. Some economists argue that deposits are ultimately generated by banks through their lending activities.
The financial sector can indeed create private money autonomously, but individual banks still face budget constraints, particularly when loans go bad. The type of depositors matters as their savings influence the bank's stability. If a large number of depositors rush to withdraw their funds simultaneously, a single bank can collapse within hours.
As we analyze the capital market, distinguishing between savings instruments and investment instruments, how is their price determined?
The issue is quite complex because assetification means that real assets, like factory machinery, are transformed in such a way that their market price, such as for used machinery, differs significantly from the price of the asset as it is represented in financial markets. In principle, these prices are connected via arbitrage. However, the speed of adaptations differs widely. It may be a mere seconds on the stock market, whereas the creation of new real assets may need years, such as a chip factory. For an asset of the same face monetary value, the underlying procedures of valuation can be very different.
In financial markets, certain claims can be transformed into derivative assets. This creates a fundamental aspect of performative reflexivity. This issue gained significant public attention during the 2008 financial crisis, when housing prices plummeted as the values of derivative assets, for example, mortgage-backed securities, deteriorated.
The fundamental aspect of reflexivity is that current prices are influenced by expectations about future prices. In turn, future prices will be shaped by the expectations prevailing in the subsequent periods, and so forth. People effectively predict their own expectations in the future.
We must also acknowledge that prices at any stage are influenced by the expectations of other market participants, including their perceptions of each other's expectations. This complex and interconnected system of expectations can lead to an infinite variety of possible outcomes.
Yes, in this context, we cannot determine the value of capital since we actively create this value through our own actions at every moment. These actions occur within the framework of our perception of the overall economic environment. For example, when we consider interest as a primary factor influencing the yield of an asset, specifically the current and expected returns, it is crucial to take expected inflation into account. This is evident in the distinction between nominal and real interest rates.
Economic actors in finance always and everywhere face radical and irreducible uncertainty. Perhaps this is one reason why liability rules are an essential element of assetification.
Designing institutional objects in the context of assetification is the business of investment banks and lawyers. Limited liability effectively reduces the risk of investing in a certain entrepreneurial project of others. This allows investors to reduce risk further by building portfolios of investment. They could not monitor all these investments, but since their liability is limited, they can afford to just look at the market trends and publicly available information about the companies.
The outcome of these developments is the modern joint stock corporation. Shareholders are fractional owners of the company. However, they cannot directly claim physical assets or interfere with its management. Their influence is expressed during shareholder assemblies or through trading stocks. While they may lose their initial investment, they cannot lose more than that. This structure allows them to participate in high-risk activities with a strong assurance of understanding the potential worst-case scenarios. We touched upon the economic implications of limited liability already in Chapter 9.
Let us summarize our fresh view of the fundamentals of money and finance. The chapter explores the role of the financial sector in institutionalizing money in the economy. The key concept is assetification. which is involved in both the private production of money and in enabling saving and investment.
We distinguish between private and sovereign money. Private money emerges in communities of exchange where debts are assetified and become tradable, such as bills of exchange. This leads to the separation between primary and secondary monetary communities, the latter commonly known as financial sector. Creditworthiness in these monetary communities is determined by network effects and general economic conditions. This creates a systematic tendency of cycles of economic activity, bolstered by leverage and driven by overexpansion and contraction of loans.
Sovereign money emerged as a unit of account of the public economy and taxation. Sovereign money in Europe, private and sovereign money were merged in the institution of national currencies. In modern banking systems, banks can create private money via credits. Central banks were established to regulate this private money.
The capital market is deconstructed into the two markets for saving instruments and investment instruments. Saving and investment are distinct economic processes, both institutionally and behaviorally. In a monetary economy, there are different types of economic actors, mostly with reference to the relative importance of monetary returns in agent decisions. The composition of these types evolves depending on the state and context of the economy.
Assetification implies that risk-averse savers demand savings instruments for risk reduction and hence pay negative interest in terms of the interest rate spread between deposits and loans. That is, the opportunity costs of saving and foregoing risky returns to investment. Risk-taking entrepreneurs pay positive returns to the producers of investment instruments such as loans, equity, and bonds.
The valuation of capital is a complex and uncertain process that is only fixed by institutionalizing specific procedures in accounting rules. This results from reflexivity of both the formation of expectations over future yields and the process of assetification. A major mechanism of risk reduction is assetification with limiting liability.
In the next lecture, we will explore the consequences of our insights for understanding the causes and effects of fluctuations of aggregate economic activity, the business cycles. We hope that you will be with us again. See you then.
Thank you for your attention.